Hey climbers, welcome back to Climb by VSC, a weekly show about building and scaling startups in the world of climate innovation. My name is Jay Kapoor, general partner of VSC Ventures and co-host of Climb. Every week, I or a member of our VSC team will speak with a pioneer in the climate tech world about emerging technologies and novel ideas that will turn the tide on climate change. We've all heard enough of the doom and gloom. It's time for stories of purpose-driven innovation that lead to sustainable, positive change. As always, I'm so happy that you've decided to join us. Now let's climb. Hey folks, welcome back to another episode of Climb by VSC. I'm your host, Jay Kapoor. Today, I am thrilled to have on our show Lior Susan, who is an investor, entrepreneur, now the founder and managing partner of Eclipse Ventures, which is a Palo Alto-based VC fund that has raised most recently $1.2 billion across their two recent funds. What I love about Eclipse is because it overlaps with a lot of the things that I love investing in. They're a team of operators and investors that are backing companies that are disrupting legacy industries. Lior, we can dive into what some of that means. And you started this fund, I guess, almost 8-9 years ago to meet the unique needs of these entrepreneurs. So I'm excited to talk about that journey and everything you've learned along the way. Right now, I'll just start by saying thank you so much for joining me on Climb.
Thank you, Jay. It's a pleasure being here. And dang, you say 8 years, and I'm like, it's been 8 years.
That time flies, huh?
I know.
Exactly. Well, I hinted at some of your kind of rich and varied career path. So maybe let's start there. You were investing as an angel. You were investing with some funds. Talk to us about the thesis of Eclipse Ventures and maybe a little bit about the stage and focus and that kind of stuff before we dive into the history.
Yeah, absolutely. I left Flex in the beginning of 2015 to start Eclipse with a single mission that I felt operating as an operator in physical industries that naturally carrying most of the world GDP, so more than 80% of $100 trillion is in old line industries, physical industries, same terminology, everything from manufacturing, industrial, energy, agriculture, supply chain, defense, etc. And I just saw on the field that there is lack of investment and lack of investors that understand how to build those companies. And I felt we're going to see a lot of Teslas and SpaceX, and I want to be on that side.
Yeah, and in terms of where you guys typically come in, stage and check size and working with your companies, help us understand that.
Yeah, so we're managing now about $4.3 billion, 25 people at the firm. As you highlighted, Jay, we are all operators that came from companies like Teslas and SpaceX and Amazon and Samsara and Apple and others. And we usually we have what we call venture equity. We will work with a founder to build a company. So that's the earlier that we will go. Then we have a team or thesis focusing on an early stage. We'll lead rounds and seed Series A, Series Bs. And we also have a growth fund that can come later stage and lead rounds in Series C and above. I would say we operate as a one team, but we have two pools of capital that allow us to build into early stage and also compound into a later stage.
Yeah. So as our listeners can probably pick up from your accent, your background is Israeli. You grew up on a kibbutz and you served in the IDF. And so talk to me about kind of that background going back to those days. Are there a couple of lessons that you take from those formative experience that have now defined how you're investing in companies today?
Yeah, I said that it's not the typical person that you will find doing investments. No, I didn't go to business school. I was not a principal in another firm. I grew up in a kibbutz, and I spent there almost 8 years of the special forces as a soldier. I would say probably two learnings that I had in both cases that I think is very reflectable to doing companies and building early stage companies and then grow those businesses, and also on the investing side. I would say from the kibbutz point of view, it's freedom. People don't lock the door. You don't know that it's community. You actually don't lock the door of the house. It's open.
Yeah.
And kids like me will go and walk while going to school. So you actually one day a week, you're actually going to walk rather than go to school. In my case, in the age of 16, I decided that it's enough school for me, and I went to work only for 2 years. But there is a lot of independency and a lot of freedom that I think it's training the muscle of this idea of taking big risks and trust your instincts and your judgment, that I think it's very relevant in the world of startups and doing things around technology. For me, so that was the kibbutz. I think the military, leadership naturally. So I led the team at the Special Forces and variety of stages, variety of tasks. And there is nothing better than leadership than managing 11, 12 people that needs to operate very far away from home with a lot of risks. So I think taking risks and leadership are something that is very, very relevant to our business.
Yeah, and we've, in our fund, backed a few entrepreneurs out of Tel Aviv and in Haifa. Nice. And, one of the interesting things I've noticed is, again, because of the military service, there's a lot of folks that come from there, but a lot of co-founders are actually made there. And to me, it seems like, folks find people with naturally aligned inclinations when they're spending all those times together.
It's there's nothing than building a bond by doing navigation with someone for 1 week with 70 kilo on your back. There's a lot of bond building. Yeah.
Exactly. So I also talked about the fact that, you are operators and your background, you had the journey of building Intucell, which you later sold to Cisco before you started Eclipse Ventures. I love speaking to investors who were operators. I think there's a natural empathy that also the founders really kind of look to. Was there something that was unconventional that ended up working for you in your journey as an operator that you now apply when you're meeting or advising founders as an investor?
Yeah, it's. I think it goes back a little bit to the roots and the notion of leadership and taking risks. When we did the Intucell, I did it with my young brother, talking about naturally having a bond with your co-founder.
Yes,
that's a blood bond. And we flew to meet AT&T, that was turned out to being our largest customer, but before they were a customer, and we brought with us a server. And we show up to the meeting with a server. And as you will expect, you have those two Israelis, broken English, terrible accents, showing up to a meeting with a server. Yeah. And the guy had this shit face of like, what is this thing?
How did you, was it in a suitcase? How did you bring it over?
It didn't fit a suitcase. We brought it in a cardboard box. And we dragged that things on this little trolley. And he's like, what is this thing? We told him, we brought the server so we can do the deployments for the POC. He was like, this is the first meeting I have with you people. You didn't even start the diligence. We didn't even do legal. We barely signed an NDA. What do you mean doing the POC? And we told him, listen, all of our savings are in these servers, and we convinced him to meet with us. We extend the trip to a 1 full week, and that in the end of that week, that server was being deployed inside their lab, showing what we are doing from software-defined network. That server became a $50 million deal over 5 years with AT&T. That essentially was the reason that Cisco bought the company.
Yeah, so, I love that story.
Yeah, it's just hustle and taking risks were worthwhile in this business.
Yeah, I love that story because I think, a lot of seed investors, there's a cliche that you say that you back the founder, right? You want to fall in love with the company and the idea, but ultimately you're going to back the founder. And it's always hard to know, does this founder have resilience and grit and creativity? And it's stories like that to me that go, yeah, I don't think anybody would have doubted your grit and resilience if you're going to bring a server and push your meeting out in order to try to close a deal.
It's a fine line of being batshit crazy and have courage and grit. It is a fine line.
So talking a little bit about the thesis of Eclipse and kind of the companies that you're looking at, I heard you say this amazing thing. You said, we are at the end of an era of globalization. And you just came back from DC as we were chatting before we got on the call. And the idea that that firms that are investing with a global viewpoint are naturally going to struggle in the next decade. So elaborate on that for me. What do you mean by this end of globalization?
Yeah, we after we did Intucell, actually moved to work for a guy named Mike McNamara, and he was a CEO of a company called Flextronics, or Flex, and they're like the American version of Foxconn, so very large industrial manufacturing. And I was focusing on the digital transformation, or build the digital transformation team. And Flex operate in these 12 segments that are describing physical industries: automotive, aerospace and defense, energy, mining and construction, etc. And we will work with the largest companies in the world. And you saw those industries essentially kind of post-World War II having a very big dependency on globalization. Actually, what allowed the GDP to grow from, I don't know, 50 trillion to $100 trillion in a matter of 30 years was because we went global. We throw our manufacturing in a low cost, we find customers elsewhere, and we became this very global community that people operate these very large industries with a lot of dependency on other countries because labor cost, or because scale, or because they're like big customers. US usually was the customer. That deal of globalization is good only for certain of country. I named a few will be a China. That actually just find a very large customers called United States that bringing a lot of GDP growth to their country calls manufacturing, and they were able to build the fastest growing economy in human history by this single deal. Now, that deal works well long term with both sides winning. And I think US won as well because our economy was growing and we were enjoying, as a consumer, be able to buy things cheaper. That deal is just not working in the last 10 years. And as a result, you're seeing countries deciding that those physical industries are national security assets. And as a result, I came from DC last night, they're going to put, in the case of the current administration, $1.2 trillion into the CHIPS Act, semiconductor, DOE or LPO, to the Department of Energy, manufacturing, onshoring. They basically going to put a lot of capital to build a domestic infrastructure that moving from globalization to essentially deglobalization.
So talking about the idea that this is actually a national defense challenge and an issue, what becomes interesting to me is that for so long, VCs have avoided interacting with anything government. And I think in both of the categories that we as a fund cover, and I know that you cover, industrial automation, climate adaptation, it seems like we are kind of on a collision course with all things government, whether it's at the local level in terms of how you're deploying, or it's at the national level in terms of where some of these tax incentives are coming from. How do you advise your companies in managing venture scale growth while still having to bump up against the challenges that is, the pace at which government operates?
It's tough. There is no shortcuts. It's tough to deal with the government. I will say that I'm extremely bullish on the current administration and the type of the talent that they brought to the administration that are very forward-thinking people. And that's the reason, tell you the truth, why I spend the time there. Because I actually think the other sides really want it. And they tell me all the time, Lior, tell us what we need to change in order to move faster. And of course, naturally allocate 1.2 trillion and build a true strategy. The infrastructure bill was the first time post-World War II that someone actually stopped for a second and say, okay, where we should invest in order to have a new economy around industrial, digital infrastructure. But there is no shortcuts, and it's not a recurrent revenue, and there is no CAC to LTV, and there is not ARR. It's different. But on the flip side, these people can give you 50, 100, $1 billion contracts. And for a startup to be able to put his hands on this size of the contract, I personally prefer that than dealing with churn and selling 20K piece of software to manage your HR. My personal taste.
Yeah, startups that have other startups as their customers. It's like a house of cards, right?
Risk on risk, I call it, yes.
Risk on risk, exactly. And one of the cool things that Eclipse has done that you mentioned at the top of our conversation is that you're incubating ideas in addition to early stage investing and then obviously supporting on it growth. I'm always curious about when a fund like yours will choose to build an idea in-house versus, it feels like there's a founder out there trying to pursue every aspect of this industrial automation or adaptation problem. What are the things that you look for before you decide to, let's say, build versus buy?
Yeah, it's actually, for us, it starts in the same way. We will build an investment thesis, and we will go and say, hey, we are a huge believer in long-duration energy storage because we believe the grid will move much more to battery-based in order to build microgrids and virtual grids. let's go and find a company that's doing long duration energy storage. In our case, we were looking for someone that's using cerium ion, because we personally believe that will be the right architecture from a chemistry point of view. And we mapped the market, and we just didn't find a company that we liked enough that had the right team, right strategy, right product. And this is usually when we will go, okay, let's just go build it. And we will bring someone that we call internally venture founder that have a unique skill set for that particular company. In that case, it's someone that was at Tesla and Nordvolt and did a lot of energy storage. And he will live with us as an employee of the firm for 6 to 12 months working on that idea till it's a mature enough for a company, and then we'll seed fund the company. But the idea is originally we started building companies mainly because we are founders and operators, and we didn't want to stop that motion. We just love building companies. And I think it's turned to be something that has much more strategic aspect of what we do. We still know that we are going to build 3 to 4 companies a year. So it's not the majority of our business, but it's definitely a very important part of our business at Eclipse. And it's also kind of keeping us very sharp on, founding businesses and kind of being essentially in the shoes of where we usually will invest in people.
So I think even more excited to have this kind of conversation with you more so than some of the folks that aren't building companies themselves, because one of the things that our listeners love to hear is pitfalls to avoid, right? What issues could they be facing down the line that maybe they're not considering today? When building in this world of physical industries, of legacy industries, old line, and whatever the terminology we all decide on one day, right? We know there's inherent resistance to change. We know there's inherent business model differences. What are some of the pitfalls that you see founders encounter most, and how do you advise your companies in navigating those?
Yeah, move fast and break things don't work in our industry. Because if I deploy an automation inside Pepsi warehouse and it's not working, I will never sell an automation again. So we are telling people, make sure that when you are deploying something, the customers is actually ready. And the reality, it's never really ready. You're always going to get it better, but it needs to meet the SLA. It needs to meet whatever you promise to the customers. You cannot bullshit the customers in this type of sectors, because you operate and selling to Fortune 50, largest energy companies in the world, largest manufacturing in the world, largest defense companies in the world, or the government. The room for error is 0. And by the way, I cannot send a new software scrap to my production, and because I'm not only dealing only with bits, I'm dealing also with atoms. So any change is very different than the pure bits. So just going with that mindset, I think it's very important. Now, on the flip side, you're creating a moat. And for the second person to replace you will be much harder for him as well. So that's why you don't see in our sectors 20 companies working on the same exact problem, is because it's really hard. And if you're able to do it, you will build Tesla or SpaceX or Amazon or Apple or now NVIDIA. It's really hard to build those companies, but it's very profitable because those markets are huge.
So that goes against the conventional wisdom that I'm hearing from founders who say, oh, my customers want a drop-in solution. They want something that, is easily replacing a human on the conveyor belt or whatever it is. But your perspective is, no, actually, you need to co-develop essentially with these customers at every stage.
You need to find strategic customers, or what we call design partners, that you find a champion there that give you almost a real-time feedback on what you build. I actually think just to dropping something, you will solve point solutions that I think the outcome of whatever you solve for me will never be that big. I'm trying to transform an industry, to do end-to-end stuff. To do a really big stuff. And in order to do it, you must having a real-time feedback from the market.
See, I love contrarian takes on the show, so I'm glad we already got one out there.
Yes.
Maybe we'll get another one on this. So we're speaking at the end of Q3. By all accounts, multi-quarter over quarter declines in Series A funding, Series B funding, might as well be frozen. Not for everybody, but has that freeze affected the way that you're thinking about capitalizing both existing companies and then also new ones that you're meeting?
We will deploy this year more capital that we ever deploy in the history of the firm on a single year. So we are like, great, awesome that I'm a fundamental conviction investor. I actually don't care what the graphs are saying. I care about the type of an assets that I'm seeing and the cost of my capital, and actually the size of the opportunity. And we're doing late stage deals, and we do early stage, and we build, and we follow on. We are all of that this year. We also didn't really, because our model that we only lead and the largest shareholder and being super close to working with the companies on a daily basis, we never let the companies, never, it's a big word. We made that mistakes many times, but in general, we don't let them run away and just basically start burning capital like madness without what we call CVD, core value drivers, that we will be measured with them to make sure that we are hitting inflection point. Now, if you hit inflection point in that big of a market that having transformation, you will raise capital regardless on the environment. Now, if you didn't, that's harder.
Yeah. And do you have benchmarks when you say, look, to get to that core value driver, I want you to have 12 months or 18 months of runway? I mean, is there a general guideline that you have for your companies in that regard?
Less about the runway, more about the core value drivers. Show me that you can do, usually we have between 4 to 5 core value drivers in each company, and we will measure it every month. Either concern, tracking, overperforming, complete, not tracking. This is the option that each of the partners will fill in our system. One day I will show you that. And as long as you hit the core value drivers, I don't care if you have 6 months of runway or 35 months. Because, you might be a zombie that have a lot of runway, but actually you're not changing anything in the world. It's bad use of my time. I prefer to put on someone that have 6 months, but is smashing the core value drivers.
So I'm noticing some common traits here, right? Which is when you're building in these industries, things will take longer. You have to manage your burn or do creative things to be able to get there. How do you identify these traits of scrappiness, resourcefulness, grit, resilience when you meet these founders? What are the core value drivers that you look for in these people to know that they're going to be able to execute on the core value drivers in the business?
It's a great conversation that this is like one of the hottest topic inside the Eclipse for many years. How we can constantly refine what is the CVD for the people that we are investing in, not only the companies. And, I can tell you that is like, be able to disagree with you. Huge core value there for us. Cannot be only yes men, but to be good listeners. So this combination of having strong opinion, but open to listening. Have people that have a continuing view. Like something that the rest of the market is doing in one thing and they want to do it in a very different things. People that can think that big. I would say one thing that we added in the last couple of years, people that are really good selling. We learned that a lot of those companies will fail because they know how to sell or don't. And selling meaning not only to our customers, also to investors and to employees and to partners. So we are constantly refining the CVD around the people, but it's the toughest one to get right. It's interesting. Our typecast for our founders will be different than our friends from the SaaS and fintech. It's actually usually people in their late 30s, early 40s. Never went to YC or anything like that. Not drop off from school, not all of these things. That being an operators for many years in SpaceX and Amazon and Tesla and Apple and, pick your favorite. What we did recently, I'm trying to think, Northvolt was one of them, Autodesk, and they're actually being a very successful operators, but they are first-time founders.
So
it's interesting. It's like usually when we talk about first-time founders, we have this idea of a kid with a hoodie and he's 22 years old, right? They actually, it's people with families that give up their job in order to follow their dream and build something. So they are coming with much more tools as an operators that we really like.
And they have the experience of maybe managing an org, which some guy in a hoodie has to learn that for the first time.
Correct. By the way, then on the flip side, they are not going to work 20 hours a day in the office and weekends because they have families. Like this really interesting balance.
Is there something you see in your portfolio that repeat founders do differently, and by that I mean better than the first-time founders? And what could the first-time founders learn from those experiences?
So we have now multiple companies that is actually people that build with us companies exit and now doing another company.
Oh,
so
that's high praise, by the way. The fact that they came back to you means that they like something.
I know. They are that crazy. And I think it's too early in the journey in the second one, so I can really point on the things that they are doing different. It's just and it's not a very scientific answer, but they just know the shit. I don't know how to better describe it. They are not getting worried about almost anything. They just know exactly. They've been there. They ran out of money. They raised money. They fired people. People left them. They lost their customer. They have the muscle memory that is very, very, very important in this business. It's not the only way to do it, but it's definitely. I'm really curious over time to measure the performance of our second-time founders versus the first time.
Yeah, I always ask that question, and you'd be surprised how often I get an answer like yours, which is, I don't exactly know how to quantify it, but they just know the decision to make. And there's no real way to shortcut that if you've never been in that situation before. You just know the decision you have to make because you've seen it before.
It's muscle memory. It's like why you take an operator in the military special forces and you make them officers. They never go straight to being officers because you want them to have the muscle memory as an operators first.
Yeah. So we do a segment on this show that we call Hyper Hopeful. Basically, I share a trend or theme or tailwind that's happening, and I'd love to get your perspective on whether it's hype or hopeful. Think of it like a rapid fire round. If there's more to unpack, then we'll unpack it. Sound good?
That's it.
Okay, so the first one is, as we're seeing this steady trend of automation in blue-collar jobs and legacy industries with higher promises of efficiency and better cost savings, we're also seeing this fear of widespread job losses. Do you think that this adoption of automation across these industries is going to be an overall hopeful shift, or hype that VCs like us are pumping up because, we believe in it?
I'm a huge hopeful on that. And actually, I'm drinking my own Kool-Aid. But I think, you don't need to guess. You can go to the books of history and see what the print press did to the print industries and how many more jobs it's been created. It's happened so many times in the history that providing a new type of an efficiency or productivity tools or technology will have a massive gain of creating a new jobs.
Yeah. It's interesting too, from our perspective on the PR side. It's so funny to me when I see, job shortages in the same industry that has fears about robots taking jobs. How can it be the same thing? You know what I mean? You can't have shortages and fears of robotics, but ultimately, that is part of the reason that, we do what we do, which is helping tell that story in a way that makes people not so afraid.
Totally.
So talking about this transition to automation, I'm trying to think of the right way to think about this. Business models is one of the challenges that we see from companies. Robotics as a service is a new business model that we've seen proposed. Seems like a great idea. Oh, I'm building recurring revenue as opposed to, doing procurement-based financing. But then you realize that you're adding a new operational complexity on top of already the thing that you're selling. Have you seen robotics as a service work in your portfolio, or is it hype or hopeful?
So up till recently, I would say it was a hype. The first time we have a company that doing that in a very successful way in the retail space that start turning me to being hopeful. And I think what the main thing that gets me hopeful is the customers that now putting the spend in their OpEx budget rather than in their CapEx budget and understand that this is where it should sit, that I just didn't see it happening before.
And what does this company do? Tell us a little bit more about it.
It's a company called Simbi Robotics. They basically, they have those robots that during nighttime will go inside the retail store or grocery, and they have 28 cameras. They basically scan the whole store, building a 3D map and an inventory map of what's happening in the store. And they give the real-time results of that and the analytics to the store. So the stores know what was the shrinkage, where they are missing product, where they have the mispricing on the product, how much and shoulders they were selling versus the other day, and which product that they're selling more. And it's just there is a very strong ROI to the customers in a matter of 3 months, and they don't sell it. They just charge $2,500 per month as a subscription.
That's fascinating. So for our listeners who don't know, at my last fund, I backed a company called Data Assembly, which was doing this from a software perspective, and it blew my mind that large grocery chains, if you're listening, probably your local grocery chain, most of them pay consultants to walk down these aisles
Correct.
with
Pen
an
and
iPad
paper.
or a clipboard and just take that. It's in 2023. It's crazy to me that that's how we're managing this. And the reason it's so important, again, is, a 50-cent mispricing because of the volume they're selling turns into, $50K loss potentially at the end of the month. So I love that. By the way, I know maybe more about this industry than I should. That's a very, very unique solution to go after that problem.
Yeah.
So we'll do one last hyper hopeful. We were chatting about Washington and politics. I'm going to stay away from the red blue of it all, but we've seen bills like the IRA, CHIPS Act, infrastructure bill, promising substantial funds to foster clean energy transition in these legacy industries. It's also a political football a little bit, right? So are you hopeful that these initiatives are going to ultimately mean more opportunity for startups? Is it hype or hopeful?
Current administration, I say it's hopeful.
Okay.
The next one, I do not know. I would say historically, I was hype.
Yeah. And why is that? Is it just the pace of execution?
It's a combination of three things. The quality of the talent that they were able to bring, people from the industry, is the strategy. They actually stop for a second to understand what is the strategy of this infrastructure bill. And I think the third one is the openness and understanding that all of that will come from the private sector, not the government sector. So they know that they need the private sector to carry the weight, and they want to partner with us as much as they can.
Yeah. Okay. That's helpful. So we'll wrap up on hyper hopeful there. A couple of questions I'd love to hear on, future predictions and market tailwinds. You've said that it's 100 trillion of GDP, 80% of it comes from physical industries.
Right.
Given the size and scale of these physical industries, as well as some of the historical resistance to change, are there 2 or 3 that you're looking at right now that you think are ripe for innovation in the next decade?
A really good question. I'll tell you where we spend the time, and kind of like that's our prediction. I don't know if it will be right or wrong. I would say 3 industries that we spend a lot of our time. It's the manufacturing industry, that I think having just a tremendous change from this globalization or deglobalization issues, geopolitics issues, and also product life cycle. People, we have a company that building servers. Now customers building 3, 4, 5 different servers every year. It used to be you build one server every 5 years. So you just can't do it in Asia anymore. So manufacturing would be the first one. I think the energy is the second one. I think electrification and in general renewable will be massive. And I think we're going to see more like a standalone private companies being built very large outcome out of that also will do good for the world. So I think you win twice over there. And I think the third one will be the industrial sector, what I would call. That naturally industrial can be fairly broad, but I think like industrial companies that we see some big changes coming out of them because they need better productivity than ever. And because the labor shortage, those 2 things just killing them. They cannot grow. And it's clear for them that they are going to put a lot of money into technology to trying to solve basically productivity gain and the shortage that they're seeing with people in order to go and continue to grow. So that's kind of the 3 sectors we spend a lot of time on.
Yeah, I'm smiling because I feel like you're writing my Fund 2 LP deck for me here, Lior. That's exactly where we like to spend our time. Exactly. I might as well. You've also talked about this idea of investing in founders and opportunities that are obviously not just better businesses, but also better prospects for the planet. You just referenced that in our last conversation. Can you share a story of a portfolio company where you kind of saw that the alignment of you could build a massive business, but also have this better for the planet vision?
Yeah, so we have this thing, we call it the 3 Ps. internally, and it's productivity, people, planet. We are not a climate investor, or we are not non-profit impact investors. We are here to make money to our endowments and pension funds. But I do believe there is something amazing in operating in cutting-edge technology in the physical world. And I will give you an example. If I can manufacturing this product, my AirPods, and I can increase the yield in 1%, meaning reduce the scrap in 1%, there is a carbon footprint to that 1% that we save by technology. And we started a report called Eclipse Carbon Optimization that we release every year, that we are trying to capture the value of our companies on the environment. Now, this is not their business. Their business is to automate the manufacturing of the AirPods. But there is a side value that can be more impactful for the environment than actually companies that directly focusing on the environment. And we want to capture that value and quantify that. And that's why we're doing every year the report. So this is on the planet. Soon we will also talk about what we are doing on the people reports. Goes back to your questions on automation, good or bad, and things like that.
Lior, you've been so wonderful with your time today. I'll close with a question that we ask all of our guests. You know, there is a lot of doom and gloom out there in terms of the lack of climate action. We're seeing hundreds of billions of dollars being spent by oil and gas and traditional industries saying things are okay, everything's all right. And naturally it can lead to a little bit of, climate anxiety. You seem like a pretty optimistic guy. What is one thing that gives you hope and optimism broadly in this, whether it's better for the planet or even this industrial transformation that we've been talking about?
To start by saying I'm concerned as a parent. And, to look on the amount of weather insanity that we're seeing in the last couple of years, I think, nobody can, regardless what you believe again, and from political point of view, nobody can ignore anymore that this globe is getting super hot. And as a result, we're going to see some very extreme weather situation. The thing I am bullish about, because go back to I'm a fundamental investors and builder, do I believe the world will move much more to use renewable energies than less? 100%. Now, the question, how long it will take and what damage we're going to do to this globe by then. But I know that at the end game will be that. And I think we're going to get technology into a place that it will be stupid to use something that it's not clean and efficient. As we were seeing in other industries, we are not there yet on the energy side, but it's getting there. You see penetration on electric vehicle. You see the amount of megawatts that being brought into the network that based on batteries and others, it's going there.
Yeah. No, I agree with you. I think ultimately you have to make the business case to people, to consumers and to businesses, right? And moving because it's sustainable, moving because it's green, moving because you're getting some tax incentives. Yes. That's very short term, right?
Yes.
We have to make the business case.
Money talk. Nobody, at the end of the day, it's market goes up, market goes down, this administration, other administration, and that's what we do in our companies. Your business model needs to be sustainable regardless of the environment. And if you're able to do it, good things will happen. You will get massive adoption, and we as a society will be able to enjoy that.
That's a great place to leave it. Lior, thank you so much for your time, for sharing your insights with our listeners, with me today. And we're excited to follow all the amazing things that Eclipse is going to be doing in the many years to come. So thank you for your time today.
Jay, pleasure being here. Thank you so much for having me.
Well, that's all for this week's episode of Climb by VSC. Thank you so much for watching and listening. Special thanks to Credo for their help in producing and promoting this episode. To visit any part of today's conversation again, you can find the full transcript on vscventures.com. Our thanks to Josue Ramiro for posting these every week. Lastly, if you've listened this far, please leave us a rating on Spotify or review on iTunes. It only takes a few seconds, really helps us out, and as far as I know, still carbon neutral. Well, that's all for now. We'll see you all next week on Climb by VSC.